Hello friends, welcome to yet another video by trading with stochastics from Stock Market Education. Now before you proceed, if you have not liked our channel, do like and subscribe to our channel, share it with your friends and don't forget to comment in the comment box. Now in this video, we will see what stochastics is. Then we will see what are the components of stochastics, what it consists of exactly, and then we'll see how we can do buying and selling of stocks or indices by using stochastics with examples. And then last we'll see what are the divergences. So as we saw in our previous videos of MACD, the similar divergences are being observed in stochastics. Now what is stochastics? Now stochastics is an indicator which is also called as an oscillator. It is a part of the oscillator indicators, and it shows where the market is overbought or oversold. Now by using stochastics, it gives you a buy signal and sell signals. So usually there is a territory for overbought zone and then there is a territory for oversold zone. We will see that in details in the next slides. Now what is the formula to calculate stochastics? Now here, as you can see, it contains percentage K, that is K is the current value of the stochastic indicator. It is calculated by closing price of last, L is last 14 days, the lowest price traded for the previous 14 trading days, divided by H14, that is the highest price traded during the same 14-day period, minus the lowest price of the previous 14 trading days into 100. So this formula looks complicated. But don't worry, you don't have to by heart this formula. This stochastics is nowadays directly available at many of the free websites. Now, what is the general or the traditional setting of stochastics? So usually stochastics, by the books or by the definition, when the stochastic goes above the level of 80, it is overbought. It is considered to be overbought. And when the stochastics goes below 20, it is considered to be oversold, right? So as we know, this is an oscillator indicator. It will vary from 0 to 100. So these are the ideal ways or the traditional settings which are observed by most of the traders. But now we will see some new settings or a new classification for this particular stochastics. So in stochastics above 70, we will see or we'll consider that as overbought level and below 30 as oversold level, right? So instead of 80 and 20, we will now consider 70 and 30. And in the previous calculations, we saw that it was using the 40 trading sessions period. Now we will see how a 10 session period along with 3 and 3 works. So this is a setting we'll be using while seeing the practical examples. Now let us see how we can trade using stochastics. So as you can see here, this is the indicator, and as you can see, this is just similar to what MACD is. It looks like, but it does not have the histogram. It has a range. Now here, as you can see, the dotted lines. The dotted line is the upper boundary, which is marked at 70, the lower boundary, which is marked at 30. Now when this blue line crosses this red line from below, it is a buy signal, and when the blue line crosses the red line from above, it is a sell signal or it is an exit signal. So whenever we want to go long, we have to wait for this particular, we can wait for this particular signal by using stochastics, and here this will be an exit point. This will be an exit indication for us. Now as we can see here you can see that it is a crossover. The blue line crossed the red line from above. So this is a sell signal. So while doing a short selling, we can do a sell here, and at the lower levels you can see in the oversold zone, it has given a positive crossover. So what we will do, we will exit our short position and we may think of going long. It is very simple to understand and to use. Most of the swing traders do this buying and selling on the basis of stochastics. When the stochastics goes to overbought territory, they will cover their long positions, and when the stochastics comes to oversold territory, they will enter long for a very small targets. Now here, as you can see, there is a chart, and you can see this was the buy signal over here. There is a crossover, and then the price was somewhere around 6,700, as you can see here, and the price from 6,700, this is a daily chart, it went around 7,700 in just a matter of few days. So it has given a good profit. So just by using the stochastics, now here you can see it was a negative crossover. So this was the time we can start booking our profits if we were gone long over here. Now similarly, for shorting opportunity, here you can see there was a negative crossover on the overbought zone, and then the price fell down, or the stochastics fell down, and it gave a buy signal somewhere here, the positive crossover. So here you can see this stock fell from around 240 levels. The highest point is around 240, and it fell around 180, 185 levels. So even this fall was a good fall. So by using stochastics, you can make good amount of profits if you really apply it very well. Now, how to use stochastics effectively? Now, if you'll see, or if you'll observe the stochastics, it gives the buy and the sell signals. Sometimes it gives fake signals also, right? So how do we avoid those fake signals? Now, remember this, when in an uptrend, wait for a dip to buy. So suppose if a stock is in an uptrend, it is going high, it is making higher high, higher low, okay? Then, and in the stochastics, you wait for a dip to buy. Suppose it gives a buy signal over here, you wait for the dip, then you buy, okay? So what we have seen in the Dow theory is when we see a bullish trend, it makes a higher high, higher low. So if we combine this Dow theory plus stochastics in an uptrend, now we know how to apply Dow theory and we can find out trends, right? So whenever we get this buy signal, you can buy over here, right? So those who have not seen the Dow theory video, do check this YouTube channel and do subscribe. Now let us see how about in the downtrend. Now in a downtrend, what happens when the price is making a lower high and lower low? The stochastics, somewhere it will bounce and it will give a sell signal, right? It will give a sell signal. So you don't have to wait, or you don't have to catch a running train or a falling knife. You just have to wait for this crossover, the stochastics, to give a sell signal. Once you get the sell signal, you can do a short selling. Okay. Now this is an example. This is a chart of Larsen and Toubro, daily chart. Okay. There's a daily chart of Larsen and Toubro, and as you can see, the price is making a higher high and a higher low. So there's a clear uptrend for this stock. Now as you can see, there are lots of buy signals over here, positive crossovers, right? So let us see which positive crossover we'll consider. Now this one can be considered, and even this one can be considered, the second one. However, this one, it is giving a buy signal almost near the oversold zone, right? This is the oversold territory and it is giving a buy signal. So this particular position or this particular price action can be considered for going long, and then you can see the price has gone up to 1780 levels, and this was in 2021, I think. You can just go and check the charts of Larsen and Toubro. So ideally, this one, a buy signal at the oversold zone in a strong uptrend can be considered as a very good buy. Now similarly, what in a downtrend? Now there is a chart of Tata Motors daily chart, and as you can clearly see, there is a downtrend that was there. Now in a downtrend, the stochastics is, as you can see, it is most of the times in the oversold zone, right? So it doesn't mean that the buy signal is always a buying opportunity, right? And here in the previous charts we saw that in an uptrend, the stochastics was most of the time in the overbought zone. So every sell signal will not be a sell signal or a short selling opportunity when the stock is in an uptrend. Similarly, for a downtrend, the stochastics can remain in the oversold zone when the stock is in a downtrend. This is a chart of Tata Motors. It is a clear downtrend. Now let us see what happens with the stochastics. Now here you see the stock was in a downtrend and the stochastics was almost in the oversold zone most of the times, but here it gave a bounce. It gave a bounce and it came in the overbought territory. Now here we can say that the stock is overbought because the main trend is down. So whenever the such stock becomes overbought, you can do a short selling, and then you can see there was a good opportunity. We would have got a good profits in this. Now again, after the first signal, the second signal, here also you can see that the price bounced. The stochastics came to the overbought territory and then it gave a sell signal. So even this would have been a good short selling opportunity with a very nice stop loss. As you can see, it is a downtrend, right? Now this is an example of ICICI Bank, and as you can see, it was previously in a downtrend. It made a low, it bounced, it made lower low, and then it bounced back, and then it turned into a bullish price action. Now here, as you can see, the price had made a lower low, but the oscillator or the stochastics here had made a higher low. So this is called as the bullish divergence, and this is considered to be a very good buying opportunity with a very small stop loss. So whenever you get a buy signal over here, whenever such bullish divergence happens, we can go long with a very small stop loss, the low of this candle as a stop loss, and then you can see the price bounced almost from 720 levels to around 830, 840 levels. So it gave a 100 rupee movement in a 700 rupee stock. So it was quite a good movement, right? So you can see there was a price making a lower low and stochastics making a higher low. This is very similar to the MACD divergence which we saw in the previous slide. Now this is an example of Hindustan Unilever. As you can see, there is a daily chart, and here you can see there was a big bull rally, and here what you can see, the price is making a higher high. However, you can see the price is making a higher high. However, stochastics here was making a lower high. So this is called as a bearish divergence. So after this bearish divergence, ideally the trend changes from bullish to bearish. So what is a bearish divergence exactly? When the price is making a higher high and the stochastics is making a lower high. So as you can see here in the chart, the price fell down from 2840 level to a level of around 2400. So it fell almost 400 rupees, right? So this could have been also a shorting opportunity. Thanks a lot for watching this video till the end. If you do have any suggestions, doubt or any queries, do write down in the comment box. I read all the comments and do reply. Keep it simple. Enjoy trading.